Welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us today. We are January 26th and it's 2022. It's our first market outlook of the new year. And welcome everyone. We appreciate you joining. Today, at this moment in time, I literally was just watching the Federal Reserve FMOC meetings announcements. In fact, we're watching markets. Markets are actually, they were trending higher as we started today, and they're continuing higher as a result. The Fed says the economic activity and employment have continued to strengthen. So we're doing this live broadcast at the same time this information is coming our way. And it's actually market moving. And it's really exciting for me because a lot of what we are set up to do today is to discuss just that: interest rates, Federal Reserve, economy, and a whole bunch of other stuff. So we are excited right now to start. I'm waiting for a few more people to join us. Again, we're going to also record this for friends and family. So I know that not all of you can stay for the entire period of time. Hopefully we're around 45 minutes today. We're going to give you our high-level overview, our outlook for 2022 as we see the world in Blanke Schein Wealth Management and how we manage our clients' assets going forward. So let's begin. Let's see. Well, there's the highlighter there. All right, so for most of you, if not all, who are with us today, and if you're new, welcome again. We also encourage you to subscribe to our YouTube channel. I have our Friday Insights and our market outlook and insights and observations. We have Rick with Financial Foundations. We have also other new guests, any special guests that we have as well. And we know that people are actually watching out there besides just my mom, because we have total subscribership well over 100 or 1,850, if you will. And total times, we have over 300 videos now and over 65,000 hours. We have to update this slide, but we're also encouraged to invite other partners and other advisors that are with us, like Jason Parr. He's new to our firm, new to our group. He's in our Minnesota office now. And we have everyone from Dawn in Milwaukee. So we have a Midwest presence and we're excited about that. And we're going to tell you a little bit more in future videos, introductions to Jason, and discuss our other growing advisorship and partners here at Blanke Schein Wealth Management. Let's see. You know, we started the YouTube direct to you, just to our clients. And that was in the heart of March of 2020. Again, it was just my little iPhone, and it was a stand, and it was in this office because we wanted to go direct to our clients to help them understand what we see and what's important, what markets are paying attention to, therefore we are too, and how we're positioning. And the reason why is because we couldn't see each other. It was back in the very beginning of the pandemic, and there's a lot of negative headlines, a lot of uncertainty at the time. And as a result, I wanted to go direct to our clients and let them know that, one, we're here, we're showing up every day, and we're constantly paying attention and proactively managing our clients and navigating them through all the rough waters. And they're always rough waters. Markets climb walls of worry, and this time right now is not any different. That being said, the YouTube and all of my publicity, if you will, out there in terms of being interviewed, got us into Bloomberg, Market Watch, even on CNBC, most recently Investors Business Daily, Fox Business. That was an early rising one. And Barron's, Yahoo Finance, Kiplinger's. In fact, they want to know what Blanke Schein Wealth Management, what our thought leadership is, and we constantly put it out there. And so now we're being picked up in the mainstream, and it's really exciting. So we encourage you to follow along and keep sharing this with all your friends and family. We thank you for your support, because it wouldn't be without you, we wouldn't be here. Upcoming meeting bookings. Now, these are subject to change. We have Yahoo Finance next week. Again, Maria Bartiromo in the mornings with Fox Business, and Fox Business in March 27th. So I'll be wearing, or March 17th, I'll be wearing, that's St. Patrick's Day. So I'll be wearing green that day, rest assured. But let's talk about 2021. And it's the greatest generation, as I said, leading the way. As I wanted to formulate and come up with our themes and what we're viewing, what we're thinking about for 2022, I want to take a look back at some of the greatest highlights. Now, a couple of things happen. One, don't always believe the media headlines. And sometimes the media headlines change so quickly, and they can't keep up, or life changes so quickly, you can't keep up with the media headlines. As an example, People magazine went to press and they published this: Betty White turns 100. God bless Betty White. She almost made it to 100 years old, but people still went to the presses with this because they already had it produced and they already had it distributed. And that's not to say that Betty White didn't have a beautiful, wonderful career, and she was inspiration to all. And what we love about Betty, as an example, why I put her here as a tribute, one, but two, just an inspiration, right? 100 years old and still working in Hollywood, still being a positive light and a source for everyone. And every time you see Betty's face, you just want to smile. And right next to her is the Money magazine, and it's the cover that I have in my office here, and it's all about retirement last year. This came out, and it says, this man is 100 years old, and he's still doing marathons. And it's talking about, is your retirement built for 3 or 4, decades, regardless of what markets are doing? That's why clients are with us here at Blanke, Schein Wealth Management, again, to navigate through the ups and downs and make certain that you have a cash flow that stays ahead of inflation and will continue to rise over time, as well as preserving those assets for your generation and future generations. But more importantly, it's the inspiration of like William Shatner. He went to outer space at his age, which is fantastic. And one final note on this: the #1 grossing tour concert in 2021 was once again the Rolling Stones. Now, they lost Charlie White in August, but they picked up in September, October, November, and finished strong in December as a legacy tribute to one of the fallen Rolling Stones. But at 80 plus years old, over 58, 60 years of just music legends, if you think about what you see right here, the real question, how we see it at Blanke Schein Wealth Management, is we're there for you every step of the way. And this, this group of characters here is just inspirational for all of us. So there's a lot more life to be living. And hopefully with this next year and coronavirus behind us, God willing, we have a lot more to do. That being said, let's go to let's talk about our sort of highlights here at Blanke Schein Wealth Management and HighTower. HighTower, as a national firm in Chicago, fiduciary mindset, ranks #2. So that's a pretty good accolade in terms of Barron's 2021 top list of firms. Again, we're a collection of the best and brightest minds across the United States, and just about all across the United States and all the different states that you see. We have over 115 advisory firms. We eclipsed 100 offices nationwide, and we're in well over 34 states. And we have 134 billion assets under management as HighTower Advisors collective partnership. That being said, we're accredited investment fiduciaries. That's a designation that's very important. If you're out there looking for an advisor, you want an advisor that's an accredited investment fiduciary. And what that means is we put the client's interest first. We have nothing to sell. There's no product that we have to sell. We're completely independent. Our clients were Schwab and Fidelity, and we have a lot of sort of the fiduciary standard is front and foremost. And Rick Jr. with us, he specifically is the next gen wealth advisor, and he is, we're proud to have him on the Forbes list of 2021. And we'll see if my nomination for Barron's is for March. We'll see if it comes out. I was nominated. I have Pam raising a hand. Let's see here. Pam, let's see. I want to see if I can. Let's see. Hey, we'll have somebody reach out to Pam, one of our clients who's raising a hand right now. I'm not that tech savvy, so I'd love to be able to help her. You can drop it in the chat, is what Sydney is saying as we're doing this live right now. Let me go to our next slide, and hopefully we can get Pam's question too at the same time. So for all of you out there, I don't know if you know, we're going to do something for the Confidence Summit in 2022. We're in conversation with that right now. Nyan, who is our Confidence Summit leader, she's in charge of that. Nyan Chandler, who works with us at Blanke Schein Wealth Management. Now she's transitioned to the Confidence Summit. So stay tuned for that. And we'll give you news, but you can follow us on social media. And again, it's Women, Wealth, and Wellness Confidence Summit. It's the Society of the Few Financially Empowered Women. It's something that I've started. It's a 501c3 that I've started on my personal mission to educate, empower women and through transition every step of their life, whether you're 9 years old or 99 years old. Again, I'm the father of 4, 3 are girls, and high school girls at that. So financial education is very important to me. And I also have 7 nieces. So the world is very bright as it relates to that. Now we have wealth management, Blanke Schein Wealth Management. We take a long view. I know the markets are very volatile as of late. We've discussed this. We've actually positioned our portfolios, and we'll discuss about that recently, how we've positioned our portfolios even the last few quarters for just this volatility. But ultimately, we take the long view, long approach for all of our clients' portfolios. And that's really how we basically say we bore our clients to wealth. We don't excite them to poverty. I mean, it's very easy to get picked up and caught up in the headlines today. And it's even easier to have knee-jerk reactions when there's volatility in the marketplace. But that's why you look to us as we guide you every step of the way, and we have a balanced approach for you. The 5 burning concerns of retirement with everyone that we sit down with, we talk about in the middle of these 5 is the lifestyle. You want the worry-free retirement. You want travel once again. You want education for the kids and grandkids and great-grandkids, or even start a new career. But it's a lifestyle. Preserve sort of where I am in life and let's enjoy it. But we also have to produce the income as well as think about the legacy of the next generation. Now, the things that actually can derail this if it's not properly looked after are the ones on the edges, which is the investments, if they're not properly balanced, situated, and looked after, or even healthcare. So obviously healthcare, long-term care, and all the healthcare related items. So we take a holistic view and approach when we create a client's overall financial plan. And that's part of our process. Any new client to us, we start with what we call the True Retirement 360. It's a dashboard. It's a 3-document solution that looks at your current situation in life, your goals, your feelings. And we also have an income statement, a net worth statement, and then what we call retirement income intelligence. For the future, we forecast in a linear fashion inflation and expenses, but more importantly, the investments and what pocket we take it out of. We are tax sensitive, so we think about taxes and how we fund the future, whether it's a cruise around the world or just a second or third retirement home. And this is the education's in the heart of what we do. And it's one of the reasons why we're here. But everything that you have, the investments are in the middle, but we provide the financial plan, the education, the guidance, the investment process, which is really done really well for our clients, and investment management for Blanke Schein Wealth Management for now over 4 decades. And obviously the service is second to none. Both Sherry and Leslie are stellar, and we wouldn't be here. I can't say enough about them. So they're fantastic. And if you've worked with them, you know why. Here is the next slide, which is all of our investment resources. Again, we're with Schwab and Fidelity, our clients who hire us as the financial advisor. And we look at everyone. So from sell-side research to institutional research to the independents like Strategis or First Trust is also a money manager that we look at. And they have great research resources for us as we craft our house view. And again, this makes the attorneys happy. I'm going to pause here for about 25 minutes so everyone can read it, but it's our disclaimer. Kidding, of course. Now let's get into the nitty gritty here. Today's market outlook and overview. There's 5 main things we're going to discuss, and we'll walk you through that. And the concerns would be, and these are all sort of FAQs, frequently asked questions that we have when we sit down with our clients as we're doing client reviews, year-end reviews, and then forecasting. Again, if you want to update your financial plan, please, we'll Zoom, we'll do a conference call, we'll do an in-person meeting at any point in time. We'll meet you where you want sort of us to help you, and we will then update your financial plan and make certain that everything's connected and we're meeting and exceeding everything from returns and expectation standpoint as well. But the question really becomes the concerns that we're all having right now are, what are the bull market enemies? Again, we reset to another bull market in March of 2020 when markets went down plus 20%, over 30% from March to April of 2020. And that technical reset really starts a new bull market for those that are following along from a technical standpoint. That being said, what stops a bull market, historically speaking? Well, rising oil prices is one key concern, and that's on the forefront on our investors' minds going forward. Higher interest rates as well, and we're going to address that. The second thing is geopolitical concerns. Is there going to be a post-Olympic event? It happened several times through history. Even Hitler made his move after the Olympics. And now we have headlines, geopolitical headlines in the Ukraine heating up right now with Putin, and you also have, obviously China and Taiwan and a few other things around the world. Again, we're always having to worry about this. We don't want to ignore this. This is something that is on the forefront, but we also want to make certain how it works into the calculus and how we manage, but we also think about the world going forward. So yes, we're not tuning out the geopolitical concerns. We're very, markets are aware, we're aware. Midterm elections, we'll discuss that. That's also sort of a concern, or how do we position ourselves appropriately given that? And there's always opportunities for that. And then the valuations, the risk trade is unwinding. Right now, in the last 2 weeks, we're seeing the valuations come down. And we're going to discuss that. The risk trade, even from all asset classes, the risk trade is off. And we'll discuss that. So portfolio positioning, how we see it, we're seeing 2022 as value versus growth. Now, it doesn't mean you sell your growth to move into value. We just say, hey, listen, in Blanke Schein Wealth Management, we have balanced portfolios. So you own value, you own growth. The question is, which one's going to outperform? And we believe that value is going to do really well, but we don't want to discount our growth, because growth in the last 24 months has done exceptional. I know year to date it's come off, but again, if you look at the true returns, they've done exceptional. So it's a balanced approach. Again, active versus passive. We're an active shop, if you will. We're not set it and forget it. So we're always waiting for opportunities in the market. We're holding cash, and then we're going to choose our spots when markets give us opportunities, as they have. And then we're also going to say, what do we do with cash? And obviously the banks aren't helping us with that. They're not paying us for our cash in the banks. So what do we do with it? So we talk about that. Now, right now, if we take a look at the slide, feeling like history is repeating itself. Why am I feeling more confused than ever? If we just see all these headlines, and the slide just really sums it up, and we understand that. But our position right now for the next 12 to 18 months is slightly bullish. We believe that if you think about it, the expectation coming into 2022, in the middle of last year, the talk and the headlines and the concern and the positioning was higher taxes and the Build Back Better plan. And that never materialized. In fact, it kind of looks like if it does materialize, whatever was in the calculus before is now resetting to lower expectations on a higher tax sort of impact if Congress gets back together and puts together a plan. It'll be interesting to see. Now, this is a midterm year, and we could see a stalemate in Washington like we did in '94 with Newt Gingrich. We had all, in '94, there was all three branches right before that were in the White House, Congress, obviously the House, Senate, and Congress were all one. And then the red wave came in then, and then that set up 95 to 99, and markets really took off with the support of Federal Reserve back then. And that was because there was a stalemate in Washington. So we don't know if that's going to happen again, but it's important to keep an eye on Washington, as well as number two, the U.S. earnings growth rate. Now, earnings are continuing to grow, but they're not growing as much. So the rate of change is changing, it's coming down. But keep in mind, earnings are still growing for corporations, and that really translates into higher equity prices. The question the market's debating is, if you increase interest rates, does that decrease earnings? That's really what's happening right now. So we have now on the forefront, hey, Federal Reserve is going to increase interest rates. Now we're going to decrease earnings or earnings expectations. That's where the balance is trying to be. The market's trying to figure that balance out right now. And that's what we're trying to take information from the Federal Reserve as they're speaking right now. Now, we know that earnings are moderating, but they're still growing. That's important. And number three, I think one of the things is we have a reopening trade once again. It sort of has fits and starts. It has supply chain issues and also labor shortage issues, and labor even trying to get employees back to work with regards to now the Omicron virus going through. We believe that's the front end, right? That's what we're worrying about right now. We don't believe that's going to happen all the way through towards the next 12 to 18 months. So that's a positive. And I will tell you, if you look at the NFL, if you watched any of the NFL games lately, this last weekend, which were fabulous, were some of the best we've ever seen. LA is hosting Rams Stadium, and who knows if the Rams can make it to the Super Bowl, but they're going to have the Super Bowl here in 2 weeks. So I think if you look at NFL, they dropped their COVID protocols and they don't test anymore. So either it's a health concern or it's not. I think right now, the reopening in big business, like we're seeing in the NFL, is trumping everything else. So I don't see sporting events and concerts, as I said, The Rolling Stones were still rolling in 2021. I don't think they're going to stop in 2022, and they even lost a band member. COVID's not stopping them. So if you see entertainment and the reopening trade resurgent, it's a good thing because that means hopefully the health crisis is in a rear view mirror. Now, cash on the sidelines, cash on the sidelines right now is up to $19 trillion if we look at businesses, states, and consumers. So the balance sheets are strong. And also another reason why we are slightly bullish is the US economy remains strong. So from that standpoint, we like the sectors like materials and consumer discretionary industrials, and obviously energy. Now, our concern here at Blanke Schein Wealth Management is not the CPI that the government says, because the government puts in there the Costco TVs that go down every single year. So technology goes down in the CPI reading that the government spits out. We and you, all of us together, have what I call CPIU, what's important on your kitchen table. And what we're all experiencing is, the day-to-days of life from Procter & Gamble, incidentally just came out earlier in this week with their earnings report, and they almost boasted. They had a positive earnings report, earnings grew, they had a really positive sort of outlook on a go-forward basis, but they boasted twice, or they boasted that they raised the goods prices on all of their goods in 2021 twice. So we're talking diapers, we're talking like basic goods that hit the lower to middle class. This is a concern. This is not a good thing. Corporate America has the pricing power. They can use technology, the price elasticity. They can outsource it outside the country. They can continue to make the earnings grow. That's why we believe you don't want to run away from solid companies that can execute and grow their balance sheet and earnings. But at the same time, we also have to consider that rising healthcare costs are still there, and it's a bigger concern than ever. You have rising housing prices, whether you're renting or buying several homes. I mean, all of this is going out. So that's where we put in our calculus for our clients. Inflation is everywhere, regardless of what we're dealing with, even in the short term right now. The balance is key. This is kind of an interesting chart that a research team here put together at Blanke Schein Wealth Management Investment Committee. It's just showing that Berkshire Hathaway, which is large cap value companies, if you will, again, that's Warren Buffett's stock, if you will, or company, versus ARK, which is Cathie Wood's innovation, high tech, high growth, like futuristic ETF, exchange traded fund, and how they both traded over the last 20 months or so, or excuse me, since this last March. And so if you want a high flyer, then that's the ARK that you're seeing, and it's come up and it's come down. We're slow and steady. Again, we bore our clients to wealth, and it's the Warren Buffett way, if you will. So that's why you want a balance of growth and value to take down the volatility. Now, I talked about the cash in the banks. Again, this is showing that this is the cash level that is still in the consumer. And if the consumer has cash, that's going to work its way into the economy. And that's very important because 2/3 of the GDP, gross domestic product, is because of what the consumer, they spend. And that's basically the velocity of money. And that's what the Federal Reserve is trying to do, is pull down the velocity of money by raising interest rates. So making the cost of money more expensive, essentially. And this right here is just shown to the right, a 60-40 portfolio, which is balanced. All of our client portfolios, just about at Blanke Schein Wealth Management, depending upon your age, situation of life, and where you are a balanced portfolio. So let's call it a 60-40 portfolio over the last 20 plus years, is showing that you're going to get a 7.9%. This is now just a balanced portfolio from FactSet, not a Blanke Schein Wealth Management actual portfolio. But again, it's in the ballpark of expectations here of what we're talking about at 60-40. 20-year annualized return is just under 8% versus 9.52 on the S&P. But what's interesting underneath that is that the standard deviation, or the risk or volatility on the S&P, is double. So you're going to get just about the same return, keeping up over time, slow and steady, balanced portfolio with just about half the risk. And that's important because it stays connected, you stay invested through the market, basically volatility. Again, we look at the economy through the leading economic indicators. There's about 12 of them, or 13 here, that we're paying attention to. Anything from weekly manufacturing hours that are worked, the ISM, consumer, all of these factors, from housing to stock prices to unemployment claims, the building permits, is showing us sort of it's really the real time in the economy. Now it's showing that the economy is slowing down. So if you look at the right-hand slope of the screen, it's slowing down. But again, I don't think it's recessionary right now. We don't believe that is. but we're paying attention. Also, the manufacturing, the PMI. So the US is still leading right now. It's above 50, but every country, like a G7, G8 country, is still in expansionary territory above 50. 50 means on the PMI, just means that the economy is expanding. So not just our economy in the US is expanding, all others. But we want to make certain that we don't contract beyond the 50 level, and that's something we'll be paying attention to. Now, what does that mean when we're watching the 10-year Treasury? I've talked about it extensively. I'm paying attention to it extensively on my market insights and observations. And if you're following along, that's exactly what we do, is because if the Federal Reserve raises interest rates, they're bringing down the leading economic indicators. That was the last slide. So those two will be slowing down. It's just basically pumping the brakes in the economy. The expectations of the Federal Reserve to raise rates, I don't want to spend any time on this because whether it's 3 rates or 4 rates, who knows? We'll ultimately know when it actually happens. But we believe the Fed's going to have to turn more dovish than hawkish. And I'll explain what that means. Now, keep in mind the Federal Reserve has, just like Hotel California with the Eagles, when they started all of the $4 trillion worth of expansion of their balance sheet or stimulus that they provided to the economy since March of 2020, that's quantitative easing, QE. And they've been doing this for multiple decades now, going back to Greenspan in the early 90s. And once they started, they really can't stop and they can't get out of it. And that's sort of the modern monetary theory that a lot of economists right now are scratching their heads saying, wait a minute, this is long-term dangerous for the Federal Reserve. Now, the balance sheet is just about under $9 trillion for the Fed, and the Fed has to pull that back and take away the punch bowl. And when you have that, there's going to be a lot of issues. The market's going to have a tantrum. This is from our last October outlook, this slide. So I haven't done anything to it. I just basically repurposed it and put it here. And I said, hey, listen, what we're worried about, what we're thinking about at Blanke Schein Wealth Management, why we're raising some cash on the balance sheet, which we did for our clients back in October, is just the fact that we believe that when you pull that much stimulus outside or off the table, it's like taking a 2-year-old from a birthday party and you're trying to extract that 2-year-old that had so much sugar and they had so much fun in the bouncy house and literally was like a Hoover vacuum with everything that they consume. And you're trying to extract them from a birthday party, which I've done several times with my kids. It's not good. It's a tantrum, right? And so it's coming off the sugar high is essentially what the market's doing. Now, I was on Yahoo Finance in December 27th of 2021, so the last week of last year. And on that interview, all the panelists were talking about this and that, and they asked Rob, what are your concerns? What do you think the market's concerned most about? And no one said what I said, and I specifically said on the air, again, a week before, we are waiting at Blanke Schein Wealth Management. We're very interested in what the Federal Reserve minutes say. They're going to be released on January 5th. And it really was going to discuss how the Fed was going to handle the transition from quantitative easing to tightening. Now, this chart shows when the Federal Reserve, again, released those minutes and the S&P 500 on the value of that S&P 500, it was about 4,800 on the S&P, and now we're at 4,200 levels right now. So this slide hasn't been unexpected, right? It's a tantrum. The child is really upset because the market's upset and concerned, like, wait a minute, if you take that much stimulus away, what's really going to hold up the economy? What's going to happen? Again, strong earnings are there. But if we go to earnings, there's the great Christopher Reeves, who is the best in my book, the best Superman of all time. But the inflationary pressures that we're seeing, or the rising of interest rates that we're seeing, have an impact on earnings. So companies are strong. They've proven over the last 24 months through COVID and coming out of COVID that they can make money. In fact, S&P in 2000 earnings were positive, and they had one quarter where everyone took a timeout because of COVID. And last year, earnings were back to pre-pandemic levels. So our economy is growing by GDP. Earnings are growing. Again, the question is what the market's been trying to calculate as to the inflationary impacts. And it's what we call as multiple compression. So the input costs, real quick, input costs like labor, supply chain, materials, go into a business, think Procter & Gamble, as we discussed. Those costs are increased. The earnings are growing, but not as much. So then future, also interest rates are going up. So there's a compression as to the future price to earnings ratio, the PE, the future sort of valuation of let's say, cash flows in the future, or how that business is even priced. And again, that's compressed because earnings are coming down a little bit, but inside the costs, labor costs are going up inside. Now, again, like companies that we just discussed are using technology and price elasticity. They're passing it along to the consumer, and they are going to ultimately make their earnings expectations. So right now, we're seeing a great market opportunity because markets are pulling back. And again, in a lot of levels, we're seeing underneath the hood, even just the indices, some of these stocks are down in anticipation of worst case scenario, 30, 40%, not just the 20 or 10% that we're seeing on the S&P or even the NASDAQ. Again, markets are overdoing it, but the concern is still real, and we understand that. Now, again, if we have the impact of raising interest rates, one of the questions is, Rob, when interest rates rise, can the stock market still go up? And this is a great piece from our friends at Strategis showing that the annualized returns from the S&P 500 during periods of rising interest rates when the federal funds rate really increases. So these are all data sets going back to 1961 to 66, 67 to 69, all the way through our most recent that we saw back in October of 2016 to 2019, when we have rising interest rate environments. And this is showing the annualized returns over those periods of time, in this case, are all positive for the S&P. Now, that doesn't predict or project what we could see on a go-forward basis, but we use history as a guide to say, hey, can corporations still earn their way out of this? And think about it this way. Interest rates are rising for one reason, because the economy is heating up. The Federal Reserve has to slow down the economy, has to get ahead of inflationary pressures. So they want to raise interest rates. So that means that everything's growing. They just don't want it to grow super fast, again, to get everything out of balance. So rising interest rates are counterintuitive. At first, everyone's like, wait a minute, what is that going to do to a lot of things? But early on, if they raise them just a little and constantly keep a sort of a measured pace and communicate effectively, like Jerome Powell is doing right now, to the markets, that can be digested very, very well. Now, this is S&P 500 performance during, again, rising interest rate environments, just by those individual years, and we break them out. And there's only about 3 years in there, or periods of time, again, that you actually saw through that data real negative returns when you saw a change in the 10-year treasury of greater than 1%. It's just another way of looking at it. But the average annual rate of return of all this data right here is a 17% on the S&P, with an average duration of raising interest rates over a 25-month period. That's an average. So, basically a 2-year period of the Federal Reserve raising interest rates before they have to moderate, historically speaking, if you take out all of those times in history. Now, the times that didn't happen positively for the S&P was the early 70s. You had the early 80s, and that's when Volcker had to really break the back of inflation, which he did, and that set up a 2-decade expansion that we saw in the equity markets. And then in the early 90s, again, 93, 94, as we discussed earlier, which was interest rate policy and then reversal by the Federal Reserve Chairman Greenspan at the time. And the S&P after that took off in 1995, after the 94 episode of raising interest rates. In 95, 96, 97, and 99, if you take those 4 years on the S&P 500 and you take the average rate of return in the S&P 500, it was over 27% annualized. Now, that just means that they slowed down the economy and they were still accommodative. Now, again, we talked about oil, and oil is going to be a big concern. We like energy. We positioning our clients, we're overweighting energy again, because we believe, because of sort of regulatory and the first action that this administration made, first day in office, the first hour in office, is to cut off our pipeline. So that means that our U.S. energy independence is ending. And we don't know if it's because, we want to do the opposite of what the guy before me did. We're not going to get into politics. Again, our clients are both red and blue, but ultimately we're all looking for green in our portfolios. So we position accordingly. That being said, this is a piece, again, from Strategis that says, hey, the forward monthly performance, whether we have interest rates rising or interest rates fall, or oil rising or falling, or just in general, can you still have positive change in the S&P 500? And this is showing in all 3 cases and scenarios, yes. To an extent, the answer is yes. We have to make certain that we don't have oil go plus to 150. Some forecasters out there say it can go as high as 150. Obviously, the geopolitical concerns that I talked about at the very beginning have a factor in this calculus here. So it has to be watched closely. That's why we're overweighting energy in our client portfolios. Again, taking advantage of what we believe could play out. Again, and finally here, we're going to talk about the midterms. Midterm elections. This is another great piece by strategists that talks about the volatility is not uncommon when you have the second year of the presidency. On the bottom left-hand side, you have the S&P corrections and the one-year performance following the correction by a presidential cycle. Again, going back to 1962 to 2020. And what it really shows is if you have a market drawdown, where that little marker is right here, if we have a market drawdown by 9% on average over that period of time, that's what was the average on the S&P during those bullet points or those sample set. The average is a 19% drawdown, and we're there right now, the 1 year following performance on average is a 31% in the S&P. Now, again, we can't predict that the S&P will perform like this, but what we do know is anything you stretch really wide will snap back. So we're seeing, again, markets pulling down this first 2 weeks of January, extreme numbers. And so who knows, the snapback could be even greater once we get these corrections behind us. And we like this. We like the fact that we're setting up the beginning of the year with a downward sort of correction because it was long overdue. Multiples have to come down. Not everything can go up. We like to pick or choose our spots for our clients with regards to their portfolios, and that's what we're doing. Now, the other side of this chart is showing the average S&P 500 performance before and then after following the midterm elections, going back to 94 and all the way through 2018. And what you're seeing is right in the middle, this line right here is the midterm election in November. And right before, at the very beginning of the year, January through March, we have market sell-off. That's in the last history of these last 7 data points through this last year. This is not uncommon, market sell-off, followed by a sideways movement. Now, I want everyone to pay attention to this. Markets could move sideways, still go up. You could sell positive returns and still make money, even though markets could be choppy in this sideways movement until we have sort of certainty, if you will, in November. And obviously from October, so from August to October, there's always the concern as we get to later stages of the summer. There's that one last sort of test the bottom of that was put in earlier this year, which is right now, and then retest in let's say August through October. And then we have off to the races, historically speaking. We'll see how this plays out. But why is that, Rob? That's because this is called certainty. We're going to have more certainty in the Federal Reserve by then. We're going to have more certainty in Congress by then. Hopefully we have stalemate because the amount of money that everyone's spending right now, I don't think it's good for anybody, and I don't care what side you're on. But we could see that. The S&P has not declined. Again, like we talked about this from strategists, they just put this out the other day. The S&P has not declined in a year after the midterm election since 1946. Hopefully this isn't that outlier year that rhymes with 46, but we believe that we're going to see that pattern once again, that, even in the face of rate hikes or rate cuts, and then post a presidential cycle, they're positive in both those cases in year two. So again, this is just a recap for all of us right now. And we're coming up in just about 45 minutes, as I promised. Our positioning for the next 12 to 18 months, again, longer view, we're bullish, slightly bullish, because of we believe that I don't think higher taxes will, in the way we were anticipating last year, materialize both for the consumer and businesses. We could see some taxes come out, but I don't think it's going to be to the scale that the market was anticipating. And that's a net positive. That's one of the reasons why we're bullish. Earnings growth is going to continue their uptrend. Again, corporations can still continue to make money. Again, Procter & Gamble and everybody, from shrinkflation to the ice cream that they're putting. I show my kids ice cream and cereal. I'm like, they're giving us less. We're paying the same amount, right? That's shrinkflation. So corporations can still pass on that to the consumer, so they'll still make money. I won't cry for them. I think we're going to bet in their case to offset those inflationary pressures, if you will, on the kitchen table. Again, COVID, we're reopening. We're going to hopefully reopen and stronger. Again, business travel is not 100%. and it's not even 20%. So we have consumers that are going to start traveling again. And then you add on the business travel once again. That's a lot to the GDP. That's a lot to the economy. So I'm betting and I'm bullish as it relates to that. That's why we're bullish there, because we believe we're still in this reopening trade. Again, cash on sidelines. If you have cash in your businesses or cash just at the bank, please call us. We'll put it to work. Strategically, we've been taking advantage of the last few weeks for our clients and putting money to work. We keep it. Our powder is dry. A lot of clients are saying, Rob, why do you guys, hey, Rob, hey, Rick, why do you guys have cash? And that's because we're waiting for opportunities like this. And our patience and the market volatility are our friends. And finally, we believe that the economy is strong for all the reasons that we just discussed. We're monitoring it on a daily basis, but we still believe we're in a strong economy because the Federal Reserve is raising interest rates. Some of the concerns out there, the residential real estate, it's super hot. It's almost too hot. So we have to watch that moderate a little bit to sort of normalize the imbalance from a supply and demand issue. Maybe raising interest rates will slow down the supply and demand and maybe get us back to an equilibrium there. That will be healthy, because right now the residential is sort of concerning because you can't get a house if you want a house. So that's something to be concerned about. And then obviously industrials and energy, consumer discretionary, all doing really well, materials. And we also like financials as well, because as interest rates rise, financials, sort of the mid-central banks will do well as well. So that's an update for now. Let's see if we have any other additional questions that we have, our resources here. And that's it. That's our update for today. Let's check. Powell's right now discussing labor markets are consistent with maximum employment. Again, employment is their other dual mandate, which is one is inflationary pressures or price stability, and the other is making certain that everyone is fully employed. And again, I think if you're out there and you need a job or you want a job, you can find a job right now, because unemployment is well under 4%. It's in the mid threes right now, but we'll see how this plays out. Markets are still holding in there. We're going to wait on every word that the Federal Reserve Chairman says, and I'll continue to provide that with my market outlook and observations and insights. And we just thank you for your support and thank you for your time today. I want to be respectful of your time. Again, a replay is coming out, and if you have any questions or you want to do a personal review, just give us a call. We're here for you. Again, thank you for all of us at Blanke, Schein Wealth Management. We'll take care. We'll see you again next time.